One dividend stock yields 9.4%. The other dividend stock yields 5.66%. But which one of these two is the better dividend stock to buy for passive income investors? That's what I'm going to look at in this comparison here between Altria Group and 3M to determine which one is the better dividend stock to buy for passive income investors. So let's take a look at these two high yield dividend stocks.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So like I mentioned, Altria Group offering investors a 9.4% dividend yield, 3M offering investors a 5.66% dividend yield, both of which offer investors a considerable amount more than if you were to be investing in government bonds, long-term that is. Long-term government bonds, those 10 years and longer, are around 4.4%, depending on if you go with 10-year, 20-year, or 30-year government bonds. So with these dividend stocks, you can get more in passive income. Of course, dividend stocks are more risky than government bonds because with government bonds, if you buy and hold them to maturity, you're only going to experience that yield to maturity. You're not going to experience the change in the price. Whereas with dividend stocks, you can experience a change in stock price that takes away your entire dividend yield. So that's why dividend stocks are more risky than government bonds. Still, I think longer term, dividend stocks are more attractive to passive income investors because they will give you a better return on investment over the long term, 10, 20, 30 years. You'll get a better return on investment with dividend stocks. So one of the more important things to consider with dividend stocks is the dividend payout ratio. The dividend payout ratio measures the percentage of earnings per share that's paid out in dividends. It's a measure of how sustainable dividends are. For instance, in this first example here, you have a dividend per share of $1.75 and earnings per share of $2. That means that's a dividend payout ratio of 88%. That's relatively high. That means if earnings per share were to decline below $1.75, that company would be paying more in dividends than it's bringing in earnings. And just like a household that cannot spend more than it brings in earnings for the long term, in the same way, a business cannot pay dividends more than it brings in earnings per share for the long term. Sure, in the short term, it can borrow money to pay the dividend, but eventually it will exhaust its borrowing capacity. Additionally, it can pay dividends out of its savings, but eventually it will run out of savings. That's why in the long term, if you want sustainable dividends, you want a dividend per share that's below earnings per share at a comfortable level, like the second example here, where you had a dividend per share of $2.75 and earnings per share of $10. That's a dividend payout ratio of 27.5%. For passive income investors, what this means is that the dividend is not only sustainable because even a drop in earnings per share of 50% would still mean that the dividend per share is below the earnings per share. But it also suggests that there is room for this company to increase the dividend payment. So investing in this company brings with it the probability that the dividend per share will rise over the next several years. And finally, the last example where we have dividend per share of $3.50 and earnings per share of $1.45, that's a dividend payout ratio of 241%. The dividend payout is more than 2 times the earnings per share. When you see a situation like this, it's likely that this company is going to pause or reduce its dividend payment. That's very likely to happen in the near term unless the company can expand its earnings per share in a relatively short amount of time. So now that you know why that's important, let's look at Altria Group and 3M. Altria Group, in the orange, its earnings per share, you can see has fluctuated above the dividend per share and below the dividend per share. And so you can see this in action where Altria Group has maintained its dividend per share despite experiencing earnings per share below for a temporary period in time. Similar, 3M has experienced a big drop-off in earnings per share. This is due to those legal disputes, the legal settlements that you've heard probably so much about with 3M, causing its earnings per share to collapse. It's maintained its dividend per share at $5.99 in the short period of time. It's above this earnings per share. However, I will say, I don't think either of these two companies, I don't think their dividend is at much risk. And we're going to see why in the next slide. So here I have Altria Group and 3M, and what I have is their cash flow from operations to sales. And with 3M, while you saw its earnings per share negative, you see its cash flow is still positive. How can that be? Well, a lot of times when companies make these legal settlements like, oh, we're going to pay $12 billion to settle this claim, in the fine print, you'll sometimes see that within that $12 billion settlement is a payment plan where the company's going to pay maybe $1 billion per year for the next 12 years. So even though it's a $12 billion headline number, the actual number might be only $1 billion per year for 12 years, which is not as meaningful as a $12 billion immediate payment in cash. But what companies will do is they'll take that write down immediately on the income statement. They'll count that $12 billion expense immediately. And so that creates that negative earnings, but the cash comes out later. And it's an accounting trick, I understand, but it is what it is. The accounting rules allow for this to happen. Altria Group, meanwhile, 42.2% in cash flow from operations to sales, a strong number, more than twice that of 3M. Now, revenue is a big concern here for both of these companies. 3M, its revenue has been declining in recent quarters because the company benefited more when people were spending more money on things and less money on services. That was happening in the earlier stages of the pandemic when people were stuck at home. Now that people want to spend more money outside on travel and services, that hasn't been good for 3M. So in the short term, its revenues have been impacted. Altria Group, meanwhile, there is a risk that its revenue will be impacted longer term. Consumption of cigarettes is declining, and worldwide governments are clamping down by adding taxes that are making it harder for people to purchase cigarettes. So it's transitioning to non-combustibles, vaping products, things like that. So transitioning its business, although you do see that its revenue has been flat or increasing a bit in the last decade. So that big overarching risk for Altria Group is more of a slow downturn. It hasn't impacted the company in a one-time big hit where its revenue has collapsed. There is still that risk apparent that it will start decreasing at a much faster rate. Although for now, Altria Group has done a good job in maintaining its operations, in transitioning slowly to non-combustibles, and perhaps it will be successful in transitioning that business to this newer consumption model. And finally, I want to look at valuation and comparing Altria Group to 3M. 3M is slightly more expensive at a price to earnings of 10 compared to Altria Group at a price to earnings of 7.7. But given Altria Group's more significant profitability and better cash flow from operations and better near-term prospects in terms of revenue and less risks from legal disputes like 3M is facing, if I was a passive income investor choosing between these two dividend stocks, I would choose Altria Group. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.